Global markets are struggling to recalibrate and balance between the hawkish Fed speak from Williams and Bostic, as well as the Israeli retaliation against Iran. S&P 500 now tracking its biggest weekly decline since October. Joining me now with the view on the market, it is David Bianco, of CIO over at DWS. David, good to have you with us. So here we are. There's a number of different big themes at play. Do I just have to be strong, accept a higher for longer narrative and a higher inflation environment, and begin to adjust accordingly?
Well, that's right. I think they're not so much new issues, just we're getting a little bit more clarity on these issues, and things aren't working out quite as the biggest optimists or biggest bulls had expected. I think what we're seeing this week, I think it's setting the tone for the summer, and I think it will be a soft summer for markets. I think the S&P 500 is going to work its way below 5,000, kind of settle in a 4,700 to 5,000 trading range up until the election. And the reasons at this stage, it's becoming pretty obvious. The Fed's going to have to wait longer before they begin cutting, and we'll even find out how much they eventually cut. And the geopolitical situation we know is still running hot. And the valuation at the S&P 500, particularly against these interest rates, and just a 20.5 PE multiple on this year's earnings estimates, this is still an expensive PE, and that's why next week, where about 40% of earnings are reported, the beats need to be big. The beats really need to be over 5% on average for us to have any, continued confidence that the $243 that we and the street are estimating are really achieved, because those estimates for the year are back-end loaded with a lot of growth coming in the third and especially fourth quarter of this year.
Where is the biggest susceptibility to disappointment on what you need to create the floor? We're at the money now at the moment. We're at the money at 5,000. So next week could be pivotal to open up the trapdoor to 47.50. So where is the susceptibility in this reporting season?
Well, there are two key parts of the S&P 500, and each of those parts has their own susceptibilities. The 492 S&P 500 index stocks that are not the grade 8 digital type names, they're susceptible to a further increase in interest rates, and I would argue their PEs at about 18.5 on average are very high versus a 4.6% 10-year Treasury yield or 2.2% 10-year TIPS yield. So the 492 is at risk to these and higher interest rates. And when we look at the earnings that are coming from those companies, particularly ex-financials, there are some green shoots of improved earnings growth, but if those companies don't beat by at least 5%, then there'll be flat earnings growth year on year again for the S&P 492. So, I mean, there are pockets of strength, industrials, there are pockets of weakness, energy and others, but this is really sluggish earnings growth outside of the grade 8, and at these interest rates, that's a concern.